All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. I'm just going to pause a second here, wait for a thumbs up. It looks like we had a couple of video issues right here. So let me just wait for the thumbs up here. In the meantime, hope you're doing well. All right, thumbs up. All right, good deal. Here I have a chart of S&P futures overnight. And, just nice kind of gentle sell-off, last night in the couple hours after the market closed, where S&P futures, dropped 20 points. This is a 20-point drop right here. Keep in mind, many days this year haven't seen 20-point ranges on them. So 20-point drop, just kind of small, right? And then from 28.55 up to basically 28.90. So essentially a 35-point rally over the course of the next 5 hours. Now, what happened here? Well, we saw New Zealand cut rates. We saw India cut rates. We saw China re-peg the yuan. We saw some positive central bank action, in terms of monetary loosening. We saw, the market make a nice little 35-point rally. And then here we go, boom, and from 28.90 down to 28.25. I mean, that's a 65-point drop. 65 points in a matter of 2 hours, and then since we hit that low, the market's rallied over 30 points. Price stability? No, there isn't any right here. Right? This is not a price stable market. We've talked about why that's going to be the case and why that is the case with the market makers and all of that. We're just not going to see price stability until we see some sort of resolution of thing. Now, what's really interesting is you have a lot of analysts coming out and broker houses coming out and chiming in on things. And Nomura, who I commented on this morning in my note, they've been, pretty bearish all year, but they're basically compared what's going to happen to what happened in 2008, which is a pretty dramatic comparison. Is the recipe there for that to possibly happen? It sure is. It sure is. Are there factors we can look at that are a little bit different? Yeah, for sure. We can definitely see a few differences from right now in 2008. But in terms of investor appetite for stocks, is there going to be any? Go look at bonds, and the reality is that ultimately investor appetite for stocks will come back. It's just how long is the kind of the fear period going to persist? And look, if you're a fund manager and you're seeing these 30-point pops in a matter of minutes, that doesn't give you comfort in terms of stepping in. This isn't the type of action that fund managers look at and go, oh, well, that's some price stability. Let's go get in. It's just more confirmation of the waves that are out there. Okay. Now for the challenge, there are no 3-7 crossovers on the board, to even evaluate for challenge trades. There is one exception, and that is Raytheon has an upside 3-7 crossover on it. Now, this is a stock that started the challenge on the watch list, but then they had the UTX news, where basically they're merging. So I took it off the watch list and said, I need to reevaluate how this thing performs, and it's currently in the evaluation mode. So not going to trade it, but does have a bullish 3-7 crossover on it. It's not an actual bullish signal, for the challenge, even if Raytheon were still on the watch list. But if it were to close here, it would most likely be a signal here today. But outside of that, there are just no 3-7 crossovers on the board, and I'll pull it up here. Quick scan. This is for the S&P 500. in some of the 3-7 crossovers. You'll notice not a single one of these stocks is on the watch list. Here's Raytheon, but none of the others are on the challenge watch list for one reason or another, and most of them because the volumes are just so low. It's just not realistic to trade. Therefore, for a challenge. So I, going to sit in cash still, and I'll talk about that just a little bit more in depth after we go take a look at a couple stocks. Let's start with Disney. Disney had earnings here after the bell yesterday, and we talked about We talked about Disney several times over the last few months, and you've heard me say they're priced for perfection. And normally I hate that term because what does it actually mean? And most stocks I just kind of disagree that they're priced for perfection. But when it came to Disney, it was one where all the good news, right? They had a lot of good news, a lot of positives. And when my father-in-law is telling me that all the positives about Disney, I know it's probably priced for perfection. Everybody already knows, right? The cat's out of the bag. There's no real secret here anymore. It is something that is just understood by everybody now. That wasn't the case, for a while, and things had to be priced in. But going into this earnings report, cat out of the bag. Now, the earnings report, it's not a pretty one. It's just not a pretty one, especially for a company who was priced for that perfection, where they had to do well, or it was going to lead to a big drop. Now here's the earnings per share miss, right? Earnings came in down here, expectations were up here. Whoop-de-doo, who cares? There's some one-time items and things like that. I don't think this is what the market's reacting to when it comes to Disney earnings. But when we look at the revenue, here's the revenue expectation, and here's the revenue realization. And yes, it's a big jump in revenue quarter over quarter, year over year, but that is due to the Fox acquisition. But the revenues with that did not get up to expectations, and that is one of the reasons why we are seeing Disney fall. Now, as we go through Disney's report and look at various things and, everything that's kind of in there, it's, path of least resistance this quarter for the stock is kind of easy to look at. This is going to be one that's going to have a pullback. And, the depth and the length of the pullback is going to be determined by the market. But ultimately, this will stage a rally ahead of next earnings season and probably push back up into this 138, 140 level. Right. And that would be my expectation. And if Disney is able to deliver next quarter, investors will take it and run. If they're not, then we'll see a secondary gap down, and the stock will probably return back into the low 100s. But this is one where the earnings report, yes, it's not pretty. Yes, the stock deserves to get hit. Yes, it deserves to go down. Is it damning to anything long-term for Disney? Not at all. And in fact, I think you can look at the report and have a better positive outlook on the long-term of Disney than you did before the report. And, for a number of factors, for a number of reasons. But, it is one of those that, I do think their long-term story is actually strengthened. And I know I don't get met with very positive feedback when I make a comment like that. Hey, stock's down big on earnings. How could the long-term improve? Everybody's selling, so of course the long-term didn't improve. No, the long-term fundamentally, it absolutely improved on this earnings. But when you look at the miss that it had for the quarter versus expectations, and in this market environment, it naturally is going to fall. Over the course of this week, I'll share with you certain stocks or different stocks that are on my shopping list. Right. And I always hesitate in doing this during market sell-offs because when I talk about a stock on my shopping list, inevitably somebody goes out, buys it, and says, "Well, you like the stock, so I just bought it here." And these are not necessarily stocks I'm buying right here. But stocks where I look at the story, right? We have a market sell-off. We have some, turmoil out there. We have some pop and drop kind of going on. And, stocks that I look at and say, hey, the story for this company hasn't changed. And this is one where, yes, the selling is understood. The selling is natural, but it is not because of the stock or the company or anything that the company is doing. And those are the types of companies that snap back the best, the fastest, and are the easiest trades when things do kind of stabilize. The two I'll share with you here today, and I'll throw a third one in here, but number one is Microsoft. And to me, this is one of the best companies out there for so many reasons, and it's one where I do not think it's priced for perfection. I don't think the story for Microsoft is still fully understood from investors. I think, yes, it's understood to a great degree, but the revolution that Microsoft has had over the last several years in moving from this, just moving from this company that's all about, it's Microsoft Office and its operating system, to a company that is, transformative when it comes to the cloud and to many other things that are happening out there. They finally have kind of abandoned some of the money-sucking projects that they've been stuck in for a long time. And it's one that, look, as far as the pullback here, it's pretty nominal. And it's also one that has nothing to do with Microsoft, being a worse company or hitting some sort of tops or hitting some sort of, earnings revenue issue or snag. If you look at the earnings per share expected growth going forward, it is still massive. If you look at the revenue growth quarter over quarter, year over year, this is one of those companies that still has that in play in a big way. And to me, one of the best stocks out there to pick up on dips. And, one where can you pick it up today and be okay? Probably, but it doesn't mean you aren't going to have to ride it to 124. Right? Just because everything's really good with Microsoft, it doesn't mean that, the stock can't fall due to market factors. And, we saw it on Friday, drop significantly. Why? Was there an announcement on Microsoft? Did something change with the board? Did something, No, none of that happened, right? It was a market thing. And so there is going to be a market element here. But to me, one of the absolute best companies to pick up when this market sell or market element kind of goes away. And, again, I don't expect that it's gone. It could be, but I think the chances of a market sell-off being done are very slim. And then the other company here is Visa. And Visa, you've heard me talk a lot about, over the years. It's a company that since its IPO, I think there's only one quarter, and that was the fourth quarter of last year. No, I'm wrong because it did hit a new high right on the first day. But, it's hit a new high, a new all-time high every single quarter since its IPO. And it's one of those companies whose price to sales is lofty. It's pretty high. Its valuations aren't super cheap. But it gives investors just something that they can't get elsewhere in terms of, this financial exposure, not to the yield curve, not to, not to holding on to debt, none of that kind of stuff. They have access, or the investors get exposure to people swiping their card, which is happening at historic at a historical clip, and Visa, they're collecting money every time there's a swipe. And the transactions just continue to increase over time. And so, they have exposure to a financial that is pretty much a tech company with just fantastic growing revenues. And to me, just kind of one of those companies out there where there's still no end in sight to all the positives that are going on. I mean, look at the revenue growth that is expected going forward. It's just that same consistent, growth quarter over quarter, year over year. That we've come to expect from Visa. And so to me, this is just one of those stocks. Very easy to say that ultimately it'll set a new high. But, again, it doesn't mean I could go buy it right here and don't have to ride it to 160. Right? Because this is just, yes, it's going to be something where if the market decides that it's going to go down even further, then, Visa's going to go with it. And that's just the reality of it. And the nature of it, but one of the best stocks to take advantage for when the time is right to be on the upside. And so those are two of my absolute favorite when it comes down to it. They're not two of the cheapest stocks. They're not value plays. You'll notice that they are revenue plays. These are companies whose revenues continue to be strong and whose revenues are not much disrupted by some of the mayhem that we see out there. Where Caterpillar revenues, they could be severely disrupted, right? When it comes to Visa, when it comes to Microsoft, they don't have that same risk. Now, I said I mentioned a third one, and this is Adobe. Now, Adobe, the thing that worries me about Adobe is just the pure valuation. The valuations are super rich when it comes to Adobe. And so, they have a similar story to Microsoft. I think Microsoft's story is a lot better, but it's similar. But I do think there's a little more risk involved when it comes to Adobe. As far as, look, if Microsoft goes and sets a new high, chances are very good that Adobe goes and sets a new high, close to the same time. But I do think there's more downside risk, associated with Adobe. When you compare the two companies. Now, Adobe does have a different earnings cycle, right? So they don't report during the typical earnings season that is just kind of wrapping up. Adobe, last report was June 18th, so they'll be reporting middle of September here. So they're one of the first glimpse, but you look at the valuations. PE is 52, forward PE is almost 30, right? Book value per share is 20, so they're trading at almost 10 times book, 14 times book. Their price to sales is 14. I mean, these are just astronomical valuation numbers when it comes to Adobe. And, you say, well, why does it keep getting bought up? Why does the stock keep going up? Well, it has everything to do with revenue growth, right? This has just been a monster revenue growth company, and so that has propelled it on higher. So I think there's just more valuation risk when it comes to Adobe than there is with Microsoft. But again, these are not valuation reasons. If we want to go look at valuations, we go look at an AT&T. Right? Then we could go start talking valuations. We want to really look at cheap valuations. We can go talk about a Ford, right? Who's trading at a forward PE of 6, whose book value per share is 9, and the stock's trading at 940. I mean, this thing's basically trading at book. Cash value per share 9, which is wrong, but 6% dividend. Here we have the ultimate value play. But what's wrong with Ford? They have no revenue growth, right? And so, yes, Adobe, Visa, Microsoft, they're more expensive. They're not value plays, but they have serious revenue growth. And as long as that revenue growth isn't threatened or disrupted in a big way, they're going to be stocks that will lead the way on another rally or another push up, here with them. Okay, so three of my favorites there. Okay. Last thing I want to comment on is the challenge. And again, no challenge trade changes here. There are no signals on the board. But I've been asked a couple times now, Jeff, why not adjust something? If we do X, Y, and Z, when the market does this, then we would get this, right? And I'll grant you, right? Had I made the decision to when I sold the calls on Valero right here, and had I made the decision to buy puts, yes, we could have run it with the ATR and taken a nice gain and all of that. And you're absolutely right? Absolutely 100% correct. But there's a difference between one-offs and short-term hindsight and long-term, solid, tested data. Markets, they change and they evolve. And we can always look over the last 5 to 10 days and go, well, if we had applied it in this way, it would have been opportune, or it would have been ideal. But the question is, okay, if we consistently apply it this way, then what are the results? Not just what are the results right here, but on a consistent basis, are the odds in our favor? And the reality is absolutely not. The reality is just, hey, had I turned the puts into calls or calls into puts, I don't have odds in my favor from a long-term perspective. At least using the metrics that the challenge is built upon. Now, is there some other combination of metrics? Yeah, probably. Right? Probably. But the challenge is built on the metrics that put the odds in the favor. Odds in favor is very different from calling each and every move and being involved in each and every uptick and each and every downtick. That's not odds in favor. That's, hey, where's my crystal ball? Let me shake it. Okay, where's it going now? Right? That's very different. And so I'm not looking or even considering any changes to the challenge based on the last week of price action. When we saw at the end of May, right? We saw at the end of May, we saw a lot of stocks have 3-7 upside crossovers, including Valero, but they never triggered. They never triggered bullish for the challenge, right? Why? Because they were coming off practically new lows. Look at the Stoke 39.1. While this isn't a factor in the challenge, it's the visual thing that I kind of show to kind of just understand, hey, it's coming off of lows. And yeah, we can get a 3-7 crossover and a nice push on up, but we're not going to get a bullish signal on that first crossover, right? Why? Because the odds are simply not in our favor that we are going to have a favorable outcome to the challenge via the ATR method. And so we don't enter. And we had a lot of these. We had Apple. We had, just a ton of stocks on the watch list do the exact same thing, but didn't create triggers. Now, a little bit of a difference between now and then is the fact that then we did have a couple stocks, right? We did have a few stocks create triggers. If we go back to the end of May, June, we had gold, right? On the last day of May, we had Under Armour on the 3rd. We had Arconic and Disney on the 4th, Visa on the 5th. So, we had a few signals come in. Wasn't a lot. In fact, relative to the number of 3-7 crossovers, there were very few signals as the market, itself was coming off a more pronounced, downtick. And so we didn't get a lot of signals. We didn't get any downside signals on this move down in the market. A lot of things like the Apples, they were coming off of highs. They weren't coming off of lower highs. They weren't coming out of consolidations. They were coming off of highs. And, so we did not see the signals come in. And so I'm not going to go and adjust and say, well, now let's go and trade stocks when the downside 3-7 crosses, when the 3-7, crosses down, when the stocks, set a new high. Why? Because I get burned hard right here. I get burned hard right here. I get burned hard right here, right? I can show you more places where I get burned doing some sort of change up on a strategy that, yes, is working right at the moment. But when you look and you go back through the data, it doesn't work on a consistent basis. It burns more than it that it plays out. And so, not going to do it. Not going to change it to put the odds out of my favor to accommodate a one-off. Again, this isn't something we haven't seen in the data over the last 3 years. It is something that's happened several times. And it's one of those things where, okay, what's the solution to it, right? Instead of sitting in cash like we are right now, well, the solution to it is adding a market vibe element, which, was in there in the last test run, but, it did not include it in this challenge simply because it's the first live algorithmic challenge. And I wanted to keep things simple, right? I just wanted to keep things simple, keep things going, and really kind of, communicate the process to the community because this is a process that's very repeatable. It's a process that, we will be repeating many, many times over the years. And, a process that, frankly, I'm excited about and, ready to rock. But it's not a process that, is going to give me a trade every moment of every day. And, let's face it, we haven't needed that, to log in some sizable gains, right, on a market that's, been rather fickle. So anyway, that's, my 2 cents on that. And so please, please understand, I do appreciate suggestions that come in to change the challenge and do this or do that. But unless it's backed up by years worth of data where the odds and probabilities are in my favor, I'm not going to be adding it into the challenge, and it's something that I would have to test out, for real time, for quite a while. This challenge algorithm wasn't just thrown together one night and okay, let's go roll it out. This is a 3-year process, and a very painstaking process, and one where we looked at a lot of variables, a lot of contingencies. I'm sure we missed something. And so I'm always open to looking at other things. But, a short-sighted reaction to what happened over the last 5 days, that just doesn't make any sense. It doesn't have any long-term value. There's no repeatability in the process. And that's what the challenge, that's what the challenge has, and it will be running off of for years to come. Thanks for hopping on. Have yourselves a fantastic day. We'll talk to you this afternoon. Take care.